Hi, everyone. I'm here with David Goldberg, who is the technical lead of Synthetix, and he is going to give us a great intro into this derivatives platform on the Ethereum blockchain. Thanks again, David, for coming back. We had a bit of a technical issue last time, but really glad to bring you back on. And yeah, I'm really just going to let you take it away. Usually we would do a bit of like an interview style back and forth with questions, but I like this this kind of approach as well, where you can sort of give us a nice overview. My name is Solomon. I'm the co-founder of Blockmatics. We're a training and education company here based in New York, and we're ramping up a lot. We used to do a lot of webinars in the past, and now we're bringing them back. Really excited to start off with a bang with David Goldberg telling us about Synthetix. So welcome, David. Take it away.
Awesome. Thanks, Solomon. So yeah, glad to be here, everybody. Looking forward to telling you a little bit about Synthetix, what we do, why it's interesting, and yeah, we'll kind of jump in. So like some background on me, how I got into the crypto space was in 2018, one of my friends and I started doing smart contract audits. So we basically, for those who are familiar, most blockchain protocols need to get, or I guess all of them need to get their code audited by third parties. And what that does is that basically helps ensure that, you can never completely eliminate risk, but it helps you mitigate risk through, business logic bugs or security bugs, et cetera. And so that's how I first got into the space. My background was as a software engineer at Salesforce, where I worked for a little bit over 4 years. If anyone here is interested in kind of learning about like how do you break into the crypto space, into DeFi, happy to kind of give a perspective on that. And then, yeah, I met the Synthetix team through doing those audits. At the time, the project was called Haven. So this was a few years ago, and they've since kind of rebranded. But I'm really excited about what they've been doing, and so I joined as a core contributor, and very excited about it. So an overview of Synthetix. So basically, Synthetix is a liquidity pool where you can go and either provide liquidity or you can go on to trade synthetic assets. So for example, we have many different synthetic assets. These are things that basically are tokenized real world assets that then are put on the Ethereum blockchain. So for example, we have, if we look at an example of the types of synthetics we have, there's fiat Synthetix tokens, there's cryptocurrencies. So we've got like ETH, Bitcoin, bunch of different ones, Link, and then there's commodities, there's indices, and we've just, in the past months, we just started ramping up adding equities, support for equities. So last week, we actually released Coinbase, Microsoft, and FANG. Before that, we had Tesla. So we've got all these synthetic equities on there. And so one of the benefits of having those on there is if you don't live in the US, if you can't purchase those stocks, maybe you live in a market where you're not allowed to buy them. Now you can get exposure. So that's one use case for the synthetic equities. And then the other is probably just if you are already in crypto and you want to get exposure to the equities without necessarily having to maybe sell your crypto, for example, you could theoretically get a loan somewhere, right? And then go and apply those funds to purchase, synthetic equities. So pretty good use cases there. So one of the first fundamental problems around any DeFi protocol is going to be how do you get liquidity in the system, right? That in and of itself is probably the hardest problem to solve for any protocol, just in generally speaking, right? It's like if there's no liquidity, it's very hard to get users. It's very hard to really have value add. And so the way that Synthetix designed their liquidity system, there's multiple types of liquidity systems. You've got automated market maker systems, like if you're familiar with the Uniswap. You've got order book, central limit order books, if you're familiar with Coinbase or Binance or any of the centralized exchanges that you're typically used to. And then part of the reason why having a limit order book isn't really feasible on chain is just because it's very expensive. There's a lot of things going on in terms of like all the transactions you would have to do. So on Ethereum, it just doesn't, it's not really feasible. And so the way Synthetix designed their system is through this idea of staking. Staking SNX creates liquidity in the system through what's called a debt pool. Okay, and so basically, if I have 100 SNX, right, I can collateralize that by sending it into the Synthetix protocol as a staker, and I can then mint SUSD. SUSD is the synthetic version of USD in the system. And so what that does is that creates liquidity, because now we've staked Synthetix token, SNX, and now we can create a synthetic asset, right? And then once that SUSD is created, it's got plenty of utility. You could go on to KWENTA exchange and you could swap it for any of these assets that we just talked about, right? You could go to Uniswap or Curve and do yield farming, right? You could swap into, synthetic ETH and then yield farm that somewhere. There's just a ton of like utility once you kind of have this creation of synthetic assets. And so again, just kind of go over the flow here. So a staker comes in, they say, I want to provide liquidity to the Synthetix system by staking. In order to do that, so they stake and then they mint SUSD. Minting is just another word for issuing, right? And so what happens then is now they have basically created liquidity, and every week we have rewards that are paid out to stakers. So on average, it varies. I think that the current rewards are around like 25%. I think around 25% is pretty typical. And so for creating that liquidity, you earn 25% SNX rewards on the creation of that liquidity. But it's not all. There's no free lunch really in financial systems ever, right? And so there are some pros and cons, which we'll talk about in a second. But this is the high level overview. Staker comes in, stakes, mints SUSD, which creates SUSD. That is considered, that's what we call debt, right? And that is added to the debt pool. And the debt pool is just all synths, all synthetic equities that exist, right? Because they all came from this flow of collateralization and minting of synthetic assets. And then you can do a whole bunch of stuff with them, like we said. So, and where do the rewards come from? So the rewards come from a combination of, you can think of it as block rewards, but it's really just inflation rewards. Like Synthetix has an inflationary supply that is providing rewards. But then in addition to that, and that doesn't go on forever. That's just like kind of in the short term. And then in addition to that, trading fees. So when people actually trade synths, right? Or do anything with synths, like we're rolling out like we have shorting, we have, we're rolling out futures, things like that. Anytime there's any trades with any synths, there's fees that are collected, and those fees are distributed to the staking stakers as rewards. So what are some of the benefits of synths, right? So we talked about like maybe you can get access to synthetic Tesla, but you don't live in a region where you could actually purchase Tesla stock. So that's one. It's censorship resistant, right? Basically, the exchanges themselves, they're not occurring against another party. They're occurring against the Synthetix debt pool, right? So basically, when you go and purchase Tesla, you're actually buying it from the debt pool, right? Which is super liquid. It's very liquid, right? And so what happens when you do that is you basically, if you're familiar with the concept of slippage, there's essentially zero slippage in the Synthetix system. So that's another pro that the liquidity system that we've built solves for. So slippage occurs when, if you're familiar with like a limit order book like Coinbase or something like that, if you put in a limit order, right, not all of it's going to get filled at the best possible price, right? There's only a certain number of market maker, supply who are saying, like if you're buying, there's only a certain number of people who are selling at the best possible price you can get, right? And so if you put your limit order in like a little bit, let's say you're buying a little bit higher, a little bit lower than where it currently trades, like you may get some of it filled at one price, but some of it filled at another price, as long as it's under your limit order. And if you're selling, it's vice versa. As long as it's above your limit order, right, you might get filled, but like not all of it will get filled at the same price. And so if you think about really big trades, like let's say you're a crypto whale and you want to move, a lot of money, or even, actually not even a whale, but just even like, we're talking like, let's say you wanted to move $10,000 or more, right? slippage becomes a real problem, right? Because you don't actually get the best possible, price you were expecting because of liquidity, the way that the order book systems work, and for other reasons, and mainly because you're trading with a market maker, right? The same thing goes on Uniswap, right? If you use Uniswap, you see there's like a little setting where you can specify like what's the max tolerance for slippage, right? That is slippage there happens because you're trading with the market maker, right? Whereas with Synthetix, you're trading with this debt pool, which is super liquid, and so there's no slippage. Hopefully that makes sense. The values for the synths, how are those determined? So in the decentralized nature, we need to use a price oracle. So an oracle is something that's a bunch of different validators saying we all validate this price is accurate from the outside world, right? Because remember, the blockchain, Ethereum, has no way of knowing what prices are from the outside world, right? It needs some mechanism to say, here are the prices for this thing, right? And so we do that using Chainlink, and that's the price oracle. And yeah, we're really excited about like the whole derivatives, derivatives on chain market, because we think it's a huge opportunity space, something like a $640 trillion market or something. So obviously a lot of potential. And one of the things that we spend a lot of time on, and like strategically we're moving, is getting leverage on chain, right? There's for trading, there's not many places where you can do futures and shorting and like options and stuff like that on chain effectively in a cost efficient way. And so that's what we're going for. And that's part of what our layer 2 strategy will be, which I'll talk about in a second. So we talked about how when you're trading, really there's no counterparty, you're just trading peer to contract, and the contract, remember, is the debt pool. And so there's zero slippage in that sense. And we kind of use infinite liquidity and zero slippage as sort of interchangeable terms. And then you can use some of these yield farming. We have a lot of different partnerships with different DeFi protocols to like help people with synths to go do yield farming. So for example, like we have some balancer pools set up with the synthetic equities where you can go and check those out. And by basically providing liquidity there, you can earn yield. And again, how do you provide liquidity? You first acquire synths, right? So you would acquire like 20% S Tesla, 80% SUSD, right? By staking, for example, like you'd stake, you'd get SUSD, you'd put 20% of it into S Tesla, and then you'd provide that to the yield farming balancer pool, right? Where you would then earn interest on that. So, all right. So what are the different trading types? We've got spot exchange, which is just swapping one synth for another. There's shorting and inverse exposure. So we have two mechanisms for that. We have inverse synths, which move in the opposite direction of long synths. Long synths are denoted by S. If you see a little S in front of a synth, that means it's long. Shorts are denoted by I. However, we basically redid the shorts mechanism. So now we're kind of getting rid of these inverse synths because they're not it's not a true short. We then went back and actually implemented a true short. So you can short Ethereum or Bitcoin. Will probably support more synths in the future. But basically you go on, you take out a loan that you then have to pay back. So like go over a simple example here for shorting. I put in 10,000 SUSD, right? So I put in basically $10,000. There's a certain amount, there's a max amount of loan I can get. So maybe I take out like let's see, ETH's like currently at 3,000, which is pretty crazy and awesome. But like, let's say I took out, one ETH loan, right? So I put in 10,000 SUSD, I took out one ETH as a loan because I thought ETH was going to go down in price, right? So I basically now owe the system $3,000 because I took out one ETH. Let's say the price of ETH gets cut in half, so it goes down by 50%, right? Now the loan I need to pay back is only worth $1,500, right? Because ETH went down in price, and so now I've actually made money because I got the loan at 3,000, I paid back the loan at 1,500, right? So that's how a true short works, and that's the mechanism we're moving forward with. And we're currently working on rolling that out on layer 2, which is we use Optimism, and I'll talk about that in a second.
David,
but again,
if I can just jump in, I'm just curious though, what's the mechanism that the inverse synth would have operated at or operates at by, and what's the advantage of a true short versus just having it the way you have it now with an inverse synth?
Yes.
Which I don't really know what that is.
Yeah, great question. So the inverse synths are denoted by I, and what that means is like it's literally just tracking the price moving opposite. So you make gains when the price goes down, and you make losses when the price goes up. However, this has drastic consequences on because there's no sort of like liquidity liquidation ratio or like collateralization ratio, and because it just has drastic effects on the debt pool. Because remember, you're always trading with the debt pool. So you're always trading with the stakers, right? And so in this case, right, when you take out that short, let's say it went from ETH got cut in half, and you repay your loan and you made $1,500, right? Because it was 3,000, now it's 1,500. So you made $1,500 because you were betting the price would go down. The debt pool pays you out the $1,500, right? And so with the iSynths, let's say there's really just like a ton of risk to the stakers. But then in addition to that, like because of that, we had to put in like basically freezes where if the price falls by a certain amount, we just like kind of freeze it, right? Which obviously is not ideal for the trading experience, but it was just sort of a necessary step we had to do to protect the stakers. So that's one reason. But again, not really a true short, right? Like you can't really go find something. Like if you want to do shorting, the way that it works is kind of how I described with you put up money, you get a loan, you pay back the loan, assuming it goes down. If it goes up, you have to pay back more, right? So anyways, we just wanted to be consistent with the way shorts actually work. And it's a much better mechanism, just like from a fundamental kind of economic standpoint. And then, we're building futures. So the way we kind of think about futures in the first step is sort of perpetuals. If you're familiar with perpetuals, that's going to be like, you basically say like, I'm going to, basically put in a certain amount that I'm basically speculating on the price direction movement. I'm going to say, I think it's going to go short. I think it's going to go long, right? So let's say I wanted to speculate on the price of Bitcoin, and I put in $10,000, dollars. So I put in, $10,000, that'd be my margin, right? And then I would say like, I think Bitcoin's going to go up. So I'm going to declare a long position, and then I can specify leverage, right? So I can just say, I want 5 times leverage, right? And there's a certain there's certain ratios that you need to have so that like you can only take out so much, you can only have so much of a position at one time based on how much you kind of put in, right, as your sort of collateral. But it's pretty exciting because then you can have more. It just allows for people who want to do these perpetual type of speculation trading to be able to do that. And then obviously at some point like potentially like having like future contracts, like where there's dates and everything. But the first step with futures is the perpetuals. And then we'll have other derivatives coming out soon. We've got like some partnerships with different options trading. So now maybe I'll just show you like the different DAPPS. So first we have the staking DApp. So when you come to Synthetix, you can see like you come here and you can stake, right? So let's say I had Synthetix in my wallet, right? I can come here, and to stake, I would just do mint. You mint SUSD, and that actually stakes your Synthetix. Now, you need to have a collateralization ratio of 500%. So you can only create debt or like synths with you need 500% more SNX staked. Okay, and so if I staked $5,000, I could create $1,000 of SUSD. And then I could go do whatever I want with that SUSD. However, when we talked about earning rewards on Synthetix. So I don't have my wallet connected right now, but basically let me see if I can just do that. I'm just going to stop my screen share, just make sure I'm don't share, I have a test wallet I use. Let me just make sure that's set up. All right, perfect. So let's go ahead and reshare. Actually, I'll switch to one where I actually have staked on layer 2, because then I can show you the layer 2 stuff, which is pretty cool.
Awesome.
As well. So let me go back to the screen share. All right, so as you can see, so in the staking DApp, you can see that we're earning, SNX stakers are currently earning 24.8% by staking, right? Now you can see there's about $2.15 billion locked in staking, which is pretty crazy. And then you see how there's like this time left box, right? So you have to, the way that the rewards work with Synthetix is you have to claim your rewards, right? And it's weekly. So so basically, if I go to, let's see, if I go to escrow here, so I'm not currently staking on layer 1 here. And so I don't have any SNX vested or escrowed. But basically when you, every week, right, for the rewards you earn, you claim them. And then the claimed rewards, they vest. There's a 12-month vest on the claimed rewards. You can withdraw your SNX that you've staked anytime, right? But the rewards you earn have a 12-month escrow. And the reason for that is just to ensure that, you know, people aren't coming on to like stake, earn rewards, and then dump, right? So that's kind of the reason behind that. And then we have like, so yeah, if I were to go here, like again, I don't have any SNX in my wallet right now, but if I did, it would show that, you know, all my SNX is transferable because I don't have any staked, right? And then when I go to mint max, it would actually say like you're staking, you know, 100 SNX, and this would allow you to create, let's see, right now, SNX is like something like 18, somewhere in the 18 range, $18. So that would be like, if I had 100, I'd have like what, 1,800 dollars worth of SNX. So I'd be able to stake like, let's see, what's the math here? Remember, I need to have that 500% ratio of collateralization. So 1,800 divided by, I'd be able to create like $360-ish, you know, roughly of SUSD. That then I could go do what, you know, whatever I want in the system with it. So, you know, and then let's say I wanted to claim my rewards, right? But I was under the collateralization ratio. There's two ways I can get myself back to the 500% collateralization ratio. One way, I can burn synths. So by burning debt, I increase, you know, now my collateral ratio, right? And let's say I had done something with my SUSD and now I need to burn SUSD. You can go on 1inch, you can go on Uniswap, you can go on Curve, you can acquire SUSD, and then you can burn your debt, right? The other way you can do it is by adding more SNX. Right? If you added more SNX, that would also affect your collateralization ratio. And again, the reason you want to be at 500% is because you want to be able to claim your SNX rewards, right? And you can't do that if you're under 500%. If you go down to 200%, if you're under 200%, you can get liquidated by someone else. So it's important you make sure you're keeping your ratio kind of in check, just like you would be if you were taking out a loan on Maker or really wherever, right? It's important that you stay on top of that stuff. So we see layer 2 here, which I think is something important to kind of look at. So so layer 2, you can see there's 5.3 million SNX staked on layer 2. So we've done a ton of work with Optimism. That's like the layer 2 solution. The reason why layer 2 is important is because, you know, when you're staking, right, and let's say you have to claim your rewards every week, you have to pay the Ethereum gas prices for that, right? And if the gas is really high, it becomes like, you know, you have to be staking a pretty decent amount to like really, for it to be worth it, right? So if you're going to stake small amounts, you probably should just go straight to L2. If you're going to stake larger amounts, it's kind of, you know, up to you. Personally, like we're trying to move, like our strategic roadmap is to move to layer 2 and offer leverage and all the trading and all these things. And so that's where I am at the moment. So basically, there's this button, switch to L2. So I can do switch to L2. I'm not sure if you can see my MetaMask, but okay, so I'm going to switch network. And now you can see I actually have staked value, right? And on layer 2, just because for a number of reasons, we made the C ratio 1,000% for right now. So you actually need the C ratio to be 1,000% on layer 2. And so you can see I staked $177.44 worth of SNX, and then I was able to create debt for $17.74, right? And so, and then if I go to my wallet and go to escrow, you can see I've got, just taking a second to load here, but basically you can see I've got, where is the claimed rewards? So earn. So I'll have some rewards to earn for staking in this next period, and I just have a day and 14 hours left to claim, right? Let's see what else. Yeah, currently on layer 2, we just have staking. We'll be bringing exchanging and leverage like shorts and futures soon. But this is live on mainnet. And then, again, part of the benefit to staking is your rewards. Trying to think if there's anything else around layer 2. You can withdraw. The withdraw, just a heads up, this is not like a Synthetix thing. This is a optimistic rollups thing. So with Optimism or Arbitrum or whatever optimistic rollup solution you use, I can go into for a second why we chose Optimism. But basically, there's a 7 to 10 day period where like waiting period to get your funds back in L1. You can still withdraw. It's just there's a 7 to 10 day wait. And the reason for that is because of this idea of fraud proofs. If you're familiar with like how these roll up chains will work, is basically they need to say in the worst case scenario, there's fraud. How much time will we need to basically prove that there's fraud, that you don't actually have the Synthetix that you say you are, right? So, or you say you do, right? So, so in that case, you basically have to, wait. It's not ideal, but that's just kind of one of the trade-offs, right? But the way we envision the future is kind of like we see people going to L2 because it's like it's super cheap and it's very fast, and so we see most of the liquidity in Ethereum moving to layer 2 solutions, and so like we don't actually think people will be withdrawing that often, but it is just a heads up I wanted to give you that if you wanted to go stake on L2, you should be aware of the 7 to 10 day period, and you should do your own research to see like, is that a game changer for you or not? And obviously in the long run, I'm sure that will get better, but just like in the meantime, that's how it works. So why Optimism and why optimistic rollups? So basically one of the reasons is because it allows us to continue writing our code in Solidity. So you may have heard of ZK rollups or zero knowledge proofs, right? While it's come out that like they probably will have support for Solidity, even potentially by later this summer, it's a lot of technical risk, right? Because we don't want to wait on someone to come out with Solidity support, and we don't want to maintain 2 code bases, right? We wanted our contracts that run on layer 1 just to be able to be compiled into layer 2 and just deployed. Right? It's just way easier for our engineering team and just like a way less risky stuff. Our code's been audited, right? It already works on L1. It's like, there's just a lot less risk that way. So that's one of the benefits for something like an optimistic rollup over a zero knowledge proof. Now, another benefit is just the fees. It's less technically challenging. And so like it's more of an immediate, like, let's move to layer 2 actual solution that we can roll out. As you can tell, this is live on mainnet, right? That being said, ZK zero knowledge proofs offer like much better scaling, right? But the way that Vitalik Buterin, the founder of Ethereum, has like a post on this subject of like optimistic rollups versus zero knowledge proofs. And so, his perspective on it is, the way I interpret it at least, is basically optimistic rollups will get us, some serious significant scaling improvements, right? It's not going to be as good as like zero knowledge proofs, but it's much more technically feasible. And by the time Ethereum 2, you've heard of Ethereum 2.0, which is moving to proof of stake, right? There's like, phase 1 and then there's phase 2. Phase 1 is going to be like where they actually do the merge, where like the wave transactions are validated and moves to proof of stake, I believe. And then I think the second phase is going to be sharding chains of Ethereum 2. So that instead of running on one chain, there'll be 64 chains that are sharded, right? So the performance gains we'll get in transactions per second, which is kind of the metrics that we're going after, will be like through the roof. And by that time, optimistic rollups will have already been rolled out and feasible. And maybe then zero knowledge proofs become possible, right? But it's sort of like at that point, you don't necessarily need zero knowledge proofs as much anymore because Ethereum's scaled, right? And so for us, we also value, where is the community going? Where is the liquidity going to be? And so that was another aspect for us. If you see, you've got Uniswap, Maker, Aave, Synthetix, like top DeFi protocols, they all have a similar, strategy and approach. It's because we recognize composability is a key aspect of DeFi and Ethereum, right? Composability meaning I can go take out a loan on Aave. I can, take that loan. I could go do something else with it on Maker. or I could go do something. I could trade it on Uniswap, or I could trade it on Synthetix, right? Or I can short something that I got from Aave on Synthetix, etc. So we're a couple minutes over. There's just one other thing I thought was pretty important to kind of jump through. So feel free to drop off. This will be recorded. So, but you know, it's just how the debt pool works, right? Because if you're thinking about staking, it's really important that you understand how the debt pool works, because there is risk, right? There's no free lunch, right? And so basically, here's a couple examples. This is just in our docs.synthetix.io/light paper. So basically, if you were starting with, let's say you deposited $250,000 worth of SNX, right? So you had $50,000 worth of SUSD, and there's two people who did that, right? Let's say that's all the debt in the system, right? So two people came on, they deposited $250,000 worth of SNX, which allowed them to create $50,000 worth of debt. Remember the 5-to-1 ratio. And so there's $100,000 of debt in the system. Let's say that Medio here goes on KWENTA, and we didn't really talk about KWENTA, but KWENTA is their trading platform. And so you can come on here and you can trade different synths, right? So you can, go SUSD to, SETH or whatever, right? Any of our synths are on there. So let's say Medio went on KWENTA, swapped the $50,000 in SUSD to SBTC, right? And then let's say Bitcoin went up by 50%, right? So you see how now Medio's got $75,000 worth of synth value, right? And see if I can blow this up a little bit. So, but however, Yan stayed in SUSD, right? So Yan just stayed in SUSD with the 50,000. So now you can see there's $125,000 worth of debt in the system, right? Because Medio's value of his Bitcoin went up and Yan stayed the same. But remember, this is all debt. This is all still debt in the system. So when the debt goes up, right, someone's got to pay. Like, let's say Medio decides to sell their 75,000 worth of BTC, someone's got to pay for the other side of it, and that's the debt pool, right? And so in this case, Medio would have made $12,500 because remember, yes, it went up 50%, but Medio's responsible for 50% of the debt pool. So if the debt pool is 125,000, Medio's responsible for 62,500 in debt, and Yan is also responsible. And you can see Yan lost $12,500, right? So the illustration here is if you think the prices of assets will go up, like SBTC, SETH, it's important to hedge your debt by owning those assets outside the system. So if, let's say, Yan went and purchased, let's say now, so now Bitcoin is half, or it's more than half. Let's see, what's 75,000 divided by 125? 75,000 divided by 125,000 is 60%. So right now in step 3 here, Bitcoin is worth 60% of the debt pool, right? 75,000 divided by 125,000 total debt. So what Yan would have done if he was smart was he would have taken what's 60% of 50,000, and he would have gone and bought Bitcoin with that amount, right? And now when Bitcoin went up by 50%, he made 12,500 in his Bitcoin, and he's now lost 12,500 in debt, but they offset, right? And so he basically hedged his debt. So it's important that you hedge your debt. We're actually going to be releasing a product we've announced in partnership with Index Co-op. They did like DPI, which is the index for like DeFi, one of the main ones. And they'll be doing like an auto sort of hedging product with us, so that you can just come on, stake, and hedge, right? But for right now, you kind of have to do the calculations, manage it on your own. And if you go to stats.synthetix.io, this is pretty important. And you scroll down to, there's a pie chart. Let's find it. You can see the pie chart here. So you can see the debt, the dominance of synths in the system. You can see SETH currently makes up 40% of the debt pool. SBTC is 10%, SUSD is 24%. So, for me, like when I stake, I just want to basically mirror sort of this debt pool. And that way, like, I'm not exposed to these crazy, debt pool risks, right? Which there is, right? So just wanted to explain that. Then on the flip side, let's say the price of Bitcoin goes down, right? If the price of Bitcoin goes down, then there's less debt in the system, right? And so you actually owe less debt if you were holding like something like SUSD, right? But the thing to remember there is like you just don't want to get caught with like holding SUSD and be out of sync with the debt pool, right? Because really that's like where you would kind of get screwed, because then in order to claim your okay, take a step back. Why are people staking if there's debt risk? It's because they're earning around 25% rewards in SNX, right? And so in an ideal world, you'd hedge your debt and then you would earn the 25% in SNX. Hopefully that makes sense. But like, that's why like, in order to claim your rewards, remember you have to have that 500% collateral ratio. So in this case, Jan would need to put in another 12,500 worth of SNX, or burn $12,500 worth of debt in order to claim for that week, right? And if you don't claim, then the rewards just go back into the pool and are split by all the claimers in the next week period. So you want to just like make sure you're getting your ratio in check and claiming.
How much time do you have
yeah.
to claim, David?
So yeah, you have a week to claim, right? So you just have
Gotcha.
to put in your claim before a week.
Yeah.
And I think if you don't, one thing you want to be aware of is you don't want to mint like less than 24 hours before you go to claim. The reason we have sort of that check in there is because we want to prevent people from taking advantage of the system by just minting and then claiming and minting and claiming and not really participating in providing liquidity in the system. That makes sense.
Makes sense.
So
yeah, I don't know if you have more that you wanted to get through, but we are a bit over time. So I just thought, you know, I mean, we're happy to have you go longer, but I just thought we'll take one or two questions if you're pretty much at the end.
Sure.
Anyway,
yeah, pretty much at the end. I guess the last thing is just to understand how, you know, interesting what we're doing around governance is. So basically the founders of Synthetix have handed over sort of the keys, so to speak, to the community, right? We have what's called a Spartan Council, and we have guardians, and these people are community members who are helping govern and lead the protocol from like a, you know, anything we want to do, we present it to the council, they vote, right? They get elected every 3 months to represent the council. And then we have these different DAOs, which stand for decentralized autonomous organizations, for grants, right? We have if you joined our Discord and checked the grants channel, you'd see we're always asking like, hey, we need help with this. We don't have bandwidth. If somebody wants to do it, we've hired multiple people full time to the protocol that way. The Synthetix DAO, which is kind of managing the treasury, right? And then the protocol DAO, which is managing all the things they need to do as we ship new features and all this stuff. So just kind of the point here is if you're thinking about getting into DeFi or starting something in DeFi, it's like the community aspect is critical. And that's something that I've been pretty blown away with. So that's pretty much it. We'll open it up for questions if anybody has any.
Yeah, amazing, David. I really appreciate that I mean, obviously this is something that we could talk about. You can go on for hours at least about, you know, to really encompass and do a good job of explaining Synthetix and everything that is on the platform. But I really love that you dipped a little bit into the L2 side, even explaining why you're using Optimism versus any of the others. So that's really cool. Yeah, and then in terms of, so there were a couple of questions. So one was around oracles in terms of how the price actually makes its way into, I guess, you know, into the Ethereum blockchain or into the SNX side. But I'll expand on that in terms of maybe also if you want to talk about how often the price gets pulled. And I was also curious in terms of how, if there's any, if the price gets affected by arbitrage at all, or if it's just solely set by the Oracle price.
Yeah, so all right, so there's a few questions there. So basically the first thing is how does a Oracle price like actually get how does it actually get, you know, sent in, right? So there's nothing on Ethereum can just happen automatically. There's no such thing as cron jobs or triggers or background jobs or anything like that, right? And so you have what's called a keeper, right? A keeper is just someone who initiates something to the blockchain on behalf of someone else, basically, right? And so, you know, Chainlink is what we use for price oracles, and they have a keeper system where someone will say, you know, here's the current price for Ethereum, for Ethereum or for Bitcoin or for Link or whatever, right? And then SETH and SBitcoin and SLink get this price, but then a bunch of other people will validate that they agree with this price that this keeper, has. And the keeper then, like, I don't know exactly how the Chainlink system works, but I assume earn some rewards. All those people earn some rewards for basically agreeing that this price is accurate. As for how long it takes to get in, it really just depends. It's going to depend on what the price feed is. It's going to depend on a whole bunch of factors. Usually it's pretty quick, but it's kind of subjective, so it's hard to answer that. The next kind of question was around like potential risk, or is there any like problems with the, can you just, maybe
well, I was
that?
asking because I know, some other kind of automated market, in automated market maker exchanges, you would, the price very often it's just, it is not really set by any outside source. It's just really based on the market of the buying and selling against the contract. And then, you would just have things aligned with the outside world via arbitrage. So if the price does diverge from what you would get on, I don't know, Coinbase, then people would buy in one and sell on the other.
Right. Yeah. So one of the challenges we face is front running. That's probably one of the main challenges almost anyone in, Ethereum faces. But the reason why we face it maybe more so than others is, like, when you make a trade on Uniswap, you're exposed to front running, right? You as a trader, you as someone swapping is exposed to front running. You don't really notice, right? You don't really notice, but there are bots. There's people who are taking advantage of this fact that, like, if you put in a big trade on Uniswap, someone could see that's going into a block and they could say, I'm going to pay a higher gas price than this person, and I'm going to get in before them. And then their big trade's going to drive the price of that asset up. And I'm going to then sell and make a gain, right? And there's, hackers who have programmed these sophisticated bots for this type of attack vector. The reason why it's a problem for Synthetix is because you remember you're dealing with the debt pool, right? So the front running is extra, like, it's an extra large problem because now the debt pool, the stakers are at risk of front running attacks, as opposed to you going on Uniswap and being at risk yourself. Most people just kind of don't even either realize or they don't care, right? But like the stakers do care, and like people could just start making money from the debt pool by doing front running. And so because of that, we've had to introduce this idea of fee reclamation, which is after you make a trade, you have to wait a couple minutes before it's basically settled, right? And that allows front running to not really have to be a factor. As we move to L2, our approach is a little bit different. Fee reclamation is like it affects the user experience for trading, right? Because when you make a trade, you want it to be instant, right? You want it to be as fast as possible. You don't want to sit there waiting for a couple minutes for it to confirm, right? And so, one of the ways we can combat that in the short term is if the fees, right, are larger than the possible front running attack, scenario, then you kind of sort of get around that. So one of the things we've been working with is on Chainlink. So Chainlink charges like, I think they're aiming for like a certain BIPS threshold for like trades in terms of the price deviations, right? So how much can the price deviate in a given period, right? And so if they can drive that down, right, that also helps protect against front running. Because basically what it's saying is like, basically we're going to, like, in the worst case, we'd have a deviation of 0.3% in the price, right? And if our fees are 0.35%, then it would make front running impractical, right? So those are types of things that we're working on trying to figure out, but it's definitely a challenge. It'll be a challenge for, I think, any protocol, right, is front running, but especially when you have this sort of staking liquidity debt pool type of structure where people aren't trading directly with others, right? So I guess the market maker would be at risk of front running too on Uniswap, right? So,
great.
Yeah, I don't know if that helps answer your question. But
oh
then,
yeah, totally.
So people are trying to always arbitrage that stuff. And so as we develop new features, we're always thinking about attack vectors. And that's like an important aspect of it.
Yeah, this definitely could be a whole separate conversation as well. So I know we're at 12:45 Eastern time. I don't know if you have time for one more question. But if you got to go, we're happy to call it right there.
Well, yeah, no, that's fine. I can
you
answer the
do
rest of the
another?
questions here. So
Yeah, yeah. If you want
when do we expect trading to go live on L2? Within like a couple weeks, like it should be pretty soon. It's hard to comment on a specific date, but I can tell you that they've already been approved by the council. We've announced that they should be going in like really soon. We've got the code merged in, right? Really, the big challenge was we had to work through like how do we want to deal with front running effectively, and so we've come up with a system that we know can at least work. And I guess the other part of it is sort of the Synthetix DAO is very they want to support anyone who's going on to L2, right? So you'll have the Synthetix DAO support with anything. And I guess the big thing for us was the chain link, price deviations, right? Combined with sort of, what are we able to, how do we just want our traders to feel comfortable and confident. And so that was the big reason why we hadn't released trading yet. That was like, we had merged trading like, weeks ago. We just had to work through some of these issues, and we finally got into a place that's pretty good. And if you, I think someone, Synthetix, I think tweeted about this yesterday, that like SIP 116 and 117 have been like, approved, and they're going in, and they're basically be live. Like, you got to find that tweet. It's hard for me to comment on specific timeframes because I don't want to be wrong, but it's like we're talking like a week or two, right? So, like again, most likely, I'm not saying that's like for sure the case, but that's what it seems like.
Cool.
How big could Synthetix actually get or not buying the underlying asset? I understand that as a staker, you should hedge by buying the real asset, but why wouldn't someone just do that in the first place? Also, how can stakers hedge with equities like Tesla and leverage? So I guess I'm a little confused on the first question of like, how big can Synthetix actually get if you're not buying the underlying asset? Maybe I don't know if there's a way, Eddie, if you can clarify, but like, I guess maybe is what you're saying, like if people are going to buy Bitcoin, like how big could Bitcoin get, really? Is that that's maybe it? I don't know. But keep in mind, like trading Bitcoin is different than being a staker and being exposed to the debt, right? If you're a big whale, why would I buy a synthetic version if I can't influence the price? Yeah, I'm still a little bit confused. I mean, I guess I can try to explain like why. So there's two different lenses, right? There's the trading lens where you don't own any debt, right? You're just trading SBTC. You're either going short on it, you're going long on it, you're doing futures, right? There's something you're doing with SBTC. There you have no debt risk. So you're like, it's just a straight up ERC20 token as far as you're concerned, right? When you are a staker, right, your staking position is different. And that's what I was referring to around going to go buy Bitcoin to hedge, right? And so I think there's a differentiation there between the trading experience and the staking experience. I don't know if that helps, but this is just merely if you're
I think that really does answer the question. I think people are sort of confusing the fact that you can be two kinds of users or more, but essentially there are two kinds of users: those that are actually just want to buy a synthetic because it's easier than buying the actual stock. Let's say buying Tesla is easier than the actual Tesla, but yeah, yeah. So you made that differentiation.
Yeah, and then how as far as like how can stakers hedge with equities like Tesla? You would just go. You could. Well, I guess if you could buy Tesla, you could. Otherwise, there's other like there's other Tesla synthetic equities. Like you could go on Binance. I think they have one. You can go on like there's like M Tesla and other things like that. But keep in mind, you don't really have to hedge with Tesla, because if we go back to, let me go back to sharing my screen for a second. Like the debt pool, it's all about the debt pool composition. And if you look at the debt pool, like if you go to stats.synthetix.io and you go to this pie chart, like Tesla is like less than, I mean, it's not even 1% of the debt pool. So there's really no purpose of hedging against Tesla. Really, you'd want to hedge against the main ones here. Like you would not want to not have any ETH exposure if you were staking, because then if ETH went up, you'd be on the hook for more debt, right? Same thing with Bitcoin. I mean, Link's, again, ETH is 40% of the debt pool right now, right? SBTC is 10% of the debt pool. S-Link is 8%, right? You probably, if you had those covered, you're probably fine. To do a true hedge, you'd go through all of these, but Tesla doesn't make up a big enough percent of the debt pool that it really matters. So
yeah, I think that makes sense.
So yeah, let me, I think there was one other question that came in, which was,
I think someone asked a question, but someone else answered it in terms of why you need to claim your rewards manually.
Oh,
yes.
Yeah. So I can answer my perspective on that too. So, in Ethereum, it's always better to do pull over push distribution from a security standpoint, right? Like, let's say something went wrong. It's just a total nightmare if you were pushing out rewards to people, right? By having them come on and claim it, it de-risks the system. You make sure that people who are actually like staking to earn rewards are earning their rewards, and not just people, like, again, trying to like do stuff and then get it, tokens and then blah, blah, blah. And also, it just kind of, it keeps people engaged. It keeps people managing their C ratio, right? Like, if you didn't have to go claim, like, you wouldn't necessarily maybe have a reason to check your C ratio, and then maybe you accidentally get liquidated and you're like, oh man, this really sucks, right? So it's kind of like also looking out for you in a way, because it helps you, give you a reason to keep your C ratio in line, right? Because you're checking it at least weekly.
Yeah, makes sense. Yeah, that was fantastic, David. Really, really appreciate you coming on. Again, the recording will be available through various channels. I believe you will be able to, anyone can access it by the same Zoom link, or the same registration link rather. But we'll also be putting it up on the Blockmatics's YouTube. Go to blockmatics.io, and I'll share it with you, David, as well. So maybe there's somewhere on the Synthetix side that it will be posted as well. Thanks everyone for joining. See you again next time. We are doing another webinar on Wednesday. You can with the Solana blockchain. So if you want to just sign up for that, join our newsletter. Again, that's blockmatics.io, and we'll see you then. Thanks again, David. Have a great day.
Yeah, thanks. If you have any follow-up questions, you could just join Synthetix Discord and find me as David G, and I'm happy to answer any follow-ups. So.
Oh, definitely.
Cool.
Good stuff.
All right. Thanks, everybody.
Bye, everyone.
Take care.
Have a great day.
All right.
Bye.
Bye.